Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. In ASEAN, the pace of recovery of the property markets varies across countries. I speak to analysts on the ground to find out what might continue to drive the sector in vastly different economies, Singapore, the Philippines and Vietnam, despite economic headwinds.
Inflation will remain high. Central banks in the developed countries are tightening their monetary policies, raising interest rates. Global growth will be weaker, and there may be a recession within the next 2 years. We have to face up to these realities. Singapore is tightly integrated into the global economy. Given our small size, in world markets, we're always a price taker. We have very little bargaining power. If the prices go up, our prices go up. If supplies are short, we are squeezed.
That was Prime Minister Lee Hsien Loong expecting a recession. Given this caution, I asked Leonard, the head of research at Knight Frank, on how he expects the Singapore property market to perform for the rest of the year.
Because we live kind of in an age of uncertainty, and even exiting or having managed the COVID-19 pandemic, even so, there are other destabilizing factors around the world. At least for this year, there should be some stability in Singapore. Probably the biggest headwind would be inflation and the rising interest rates. But for the private residential market, because of the amount, the underlying buyer demand, despite the cooling measures, there should be still a new sale volume of about 8,000 to 9,000 units. This is less, of course, compared to the 13,000 that was sold in 2021. Maybe 16 to 19,000 in the resale market. This would reflect a total private home sales volume of between 24 to 28,000 units this year, 2022, which is something like 17 to 28% less compared to the very robust, almost 34,000 units that were chalked up in 2021. Price-wise, considering the cooling measures and the expected rise in interest rates, residential prices would be milder at a rise of maybe 1 to 3% for the whole of 2022, given that we just went through about 4.5 months of pause. In the luxury class of homes, it is expected that the core central region would take off sometime in 2021 with greater cross-border travel, notwithstanding the increase in additional buyer stamp duty for foreigners. Others might still be interested in purchasing luxury homes in the CCR. This is the core central region, where prices did not increase as much compared to other parts of the island. Given the amount of inquiries that we've been getting from foreign home buyers, even during the COVID years, the global pandemic has created this premium on stability in an uncertain world. And Singapore represents that beacon of safety and security, and some should still be willing to pay the additional 30% ABSD as a premium for entry into Singapore's prime residential market.
How are property developers navigating the prospect of a winter economy?
Developers acknowledging that there is ample domestic buyer demand and also leasing demand have to balance rising construction costs and the inevitable increase of the cost of borrowing. Hence, developers are very selective in the type of development sites that they will be interested in. Collective sales sites must be priced within the parameters of their risk profile. And I think there is an overall mood of caution amid the hopefulness. Other developers have adopted a watch and wait attitude, just trying to assess how the future, at least the immediate term, is going to pan out, while others who have the reach are venturing to opportunities in overseas markets. Popular overseas destinations, at least for Singaporean real estate investors, would be in the stabilized economies such as the United Kingdom, United States, and Australia.
As people return to offices and in an economic slowdown, what other drivers might support demand for homes and upgrades?
The trends are, I think, housing aspirations. Even notwithstanding that we went through a great global crisis and Singapore had the worst economic recession in its own modern history in 2020, there still is this aspirational ambition to upgrade. So you now have a crop of HDB upgraders whose homes have just turned 5 years, either recently or in the last few years, and they are looking at monetizing that to make the transit into the private market, and then it works its way up the ladder. Um, the HDB, those who first bought HDB and they are realizing 30 to 50% profits now from new family formations. So it keeps on rebuilding and cycling into itself. It moves on up the market from the lowest rung of HDB upgraders into entry-level suburban homes, and thereon the suburban homeowners who are selling also at profits because the price index is all-time high. So using that to move on up into bigger, better located properties.
What is supportive is that many Singapore residents have high savings or saw the value of their homes rise substantially in the last few years.
I think right at the base of it is Singapore in the decade that has passed since exiting the global financial crisis after 2010, there has been uninterrupted income growth and affluence at all levels of society. So while it has not been super spectacular, it has been steady, and it has been in such a manner that household incomes have grown, savings have grown, allowing families to move on up the social ladder or the economic ladder. Also, Singapore, since nation building, has had two generations who have made some wealth out of their own real estate, from a nation that was transiting from developing to developed to mature. So I guess there is also some recycling of capital when older generations pass this wealth down to the next generation, enabling them to make also the jump into the upper rungs of the housing pyramid.
What about the office sector now that hybrid work arrangements are in place? Employers might need less space?
The office sector has had a little bit of a struggle, as you would expect during the COVID years. Office rents kind of declined in the first half of 2021 before bottoming out in the third quarter 2021 and then improving a little bit in the last quarter last year. The office market was and has been, still is in a state of transition where work from home, work from anywhere, remote working, hybrid working, office users are incorporating these new forms of working and re-evaluating their office space needs. Nevertheless, at the start of 2022, rents are starting to firm up and strengthen. Corporate users are taking up smaller but better quality space. In addition, technology firms have also been expanding their office footprint in Singapore.
Could this lend to more demand for co-working spaces?
Yes, I think co-working is on an expansionary path because it offers flexibility, and it offers not only flexibility, it offers flexibility of location also. But that said, the main bulk of space user increase in the COVID years have come from the technology companies, which actually are taking the opportunity to find CBD space. Well, you would expect that technology firms can really work anywhere, but they have found that while CBD rents were relatively reasonable during the COVID years, taking the opportunity to establish that space, because for their type of industry, innovation needs bringing people together in the office to be creative together actually is part of the process, and it is kind of critical for them in creative industries.
Okay, so tech companies are wanting to be in the CBD central area for convenience or perhaps for prestige, but their share prices have taken a beating. Some have missed earnings estimates, and a technical recession in the US cannot be ruled out. I wonder if tech firms will continue to be so bullish about expanding their physical footprints in this part of the world.
Right now, they are still in expansionary mode. And I think at a fundamental level, despite whatever headwinds that might be on the tech horizon, the future is in tech. Everyone uses tech. And the pandemic has taught us that without tech, everything kind of freezes up. The fact that things still could run to some level was run in cyberspace during the pandemic years when everything was in physical lockdown.
So is there already a concrete shift back to working at the office?
Just a simple tracking of Google mobility data, it just shows based on individual handphones, who's in the office or who's at home. Workers in Singapore have returned to the office about 3 to 4 days a week. These levels are much higher than much higher than when we were in circuit breaker in 2020 and various periods of 2021 when restrictions were imposed and then reimposed over and over again. It will probably hover at this 3 to 4 day level for the rest of 2022.
From conversations with developers and high net worth clients, what are some interesting observations?
Born out of the pandemic, there's been a lot of shophouse interest. Shophouse is kind of fixed stock in Singapore because nobody builds them anymore. They are heritage product. Private offices, family offices are going into shophouses for its cultural affinity, nostalgia, and local familiarity. That said, prices of shophouses are at a high because there's more demand chasing limited supply. Some owners are unwilling to sell or consider selling unless a really enticing premium is offered. Investor interest for shophouse as a defensive class remains firm. This is supported by steady gentrification in shophouse districts, continuing to fuel demand, and it's expected that total sales value for shophouse this year, 2022, could reach 2 billion, almost 2 billion, especially so when there also will be some moderate spillover effects from investors who previously had an eye on the residential sector, but now are discouraged by the additional ABSD, the cooling measures announced last December 2021.
The rise of more family offices and wealthy mainland Chinese business families parking their wealth here is contributing to the property market resilience in Singapore.
So in an uncertain world where fortunes might be lost by a quick twist of fate, the globally mobile wealthy see Singapore as a safe place to be. We might not be as exciting as some places in the world, but safety and security, I think, is the new blue chip and cannot be underrated. Chinese investors have been interested during the pandemic years and continue to make small but steady inroads in terms of their purchases. But of course, with the current lockdowns in China now, we will have to wait before we see some of the activity pick up again. Because of some of the political tensions, there has been some increase in professionals coming from Hong Kong. And these are moving the rental market, the private residential rental markets up. It's not really translating into sales as yet. Perhaps they would like to reside here for a certain time, obtain the necessary permanent resident status before making an actual purchase. In Knight Frank's 2022 Wealth Report, Singapore was actually ranked among Asian buyers as the number one Asian location to be if they had to buy a home outside their own country.
How much do investors really care about sustainability when it comes to making property decisions?
So many of the wealthy in Singapore and around Asia are concerned with, future-proofing their assets. In Singapore, many high net worths want to make an impact also, to make the world a better place to pass to their children. The key challenge of promoting ESG in real estate, however, is accessibility to reliable, consistent, standardized data so that analysis and objective comparison can be made for decision making in the days ahead.
I am humble because for anyone in public service or in a public life, the most valuable thing you may receive from a fellow citizen is their vote, because embedded in that vote are their hopes and their aspirations for the future. But also embedded in that vote are the trust and the confidence that they give to you to take them to that aspirational future. And that is why to have received over 31 million votes from our countrymen is valuable a expression of trust as can be had by anyone in public life.
That was President-elect Ferdinand Marcos Jr. speaking on the 25th of May after the House of Representatives proclaimed him as President of the Philippines. I asked Miguel Sevidal, Maybank analyst based in Manila, on what Marcos Jr.'s win means for the local property market.
The good thing about the property sector is that the drivers are secular. They're structural, so they're long-term, and generally there's some resilience regardless of the transition to another administration. This presidency has, I think, expressed support for the continuous support for the business process outsourcing sector. So I think that will continue to help the office market. I don't see any major changes to the residential segment in terms of a regulation standpoint. So I think the sector should be fine. It should continue to enjoy these structural drivers. We're still maintaining our bias for residential development heavy names over mall leasing heavy names.
Why do you prefer developers over landlords?
In terms of drivers, while mall leasing is really at the mercy of macroeconomic factors, it faces more headline risks from oil-driven risk exposures, higher inflation, of course, the lingering effects of the pandemic. Your residential development, especially the upscale to luxury segments, they're enjoying structural drivers, secular trends. We saw that in 2021 when pre-sales data was still healthy for the upscale to luxury segments, despite broad macroeconomic challenges. So it's really a call on stronger structural drivers and, I guess, more manageable downside risks.
The luxury segment has been more resilient because the rich were less or not really affected by the pandemic.
That's correct. And I think the higher income segments generally saw their incomes intact. Purchasing power was not dented amid the pandemic. Hence, starting 2021, you saw pent-up demand for the housing market, especially in those higher price points. Whereas your lower income segments, which covers the, I guess, economic housing segments of the market, they're the ones who saw incomes contract, who saw probably underemployment or job loss, hence the challenges to low-cost housing or the economic housing price point.
How do you expect the luxury segment will continue to hold up as there's more economic caution going forward?
As far as the loan-to-value ratios are concerned, they're still relatively healthy. We're hearing that the LTV ratios are below 30%, so it's quite supportive of large ticket spending in the higher income segment of the residential market.
What are trends to watch out for in the property segment?
I think data centers are an interesting story, and as far as our house view and research, it's, I guess, the next emerging lever for growth for Philippine REITs and the Philippine office market following your business process outsourcing. The thing about data centers is that right now, of course, they're concentrated amid the large players, specifically telco companies. But once we attract hyperscalers, which was sort of achieved, or which we made a first step on with the sale of or with the I guess possible transactions for the data center assets and the amendments to the foreign ownership limits in the Public Service Act and other key pieces of legislation. So with those kind of factors going for us, I think data centers will see renewed interest or sustained interest and growth, and eventually become the next lever for the Philippine REIT market and the Philippine office sector.
How soon will the REITs market pick up, and what time frame are you looking at?
I'd give it a 3-year time horizon. We're still in the recovery phase of the pandemic, so I think there's some caution as far as attracting data center investments. But I think the other good thing going for the Philippine office or the Philippine REIT space is, since the REIT space is primarily office, so BPOs are still upbeat. BPOs, for all of the macroeconomic headwinds, they still expanded by about mid-single digit growth in 2021. For all of the macroeconomic challenges, they're still upbeat. The sectors that our BPOs are servicing, such as e-commerce, financial services, logistics, they're growing. So I think that there's still going to be, we're still in that phase where BPO is the main driver, but give it 3 or 5 years, we're gonna start to see more data center, a larger share in the, I guess, the pie of the pie. Eventually, I think the growth of data centers will outpace the current growth we're seeing for BPOs.
What are Maybank's top property picks?
So our top pick continues to be Ayala Land for the property space, and then for the REIT space, our top pick is the Ayala Land subsidiary, REIT. For Ayala Land, it's our poster child for the developers over landlords investment thesis. The Ayala Land is around 75% of revenue, at least 75% of net income is from residential development. And that, of course, as I've mentioned earlier, benefits from your structural drivers. The land bank is sizable, about 13 hectares. So it gives it an economic moat, provides downside protection. The land bank is easily 70% of the RNAV. Now, for the REIT space, our topic is A-REIT. Right now, among the REITs in our active coverage, A-REIT offers the highest total return, about 36-37%. The dividend yield is decent, about 5.2%. But I think with A-REIT, the main, I guess, selling point here is the upside from potential infusions. Its parent has one of the most sizable bases that can easily be injected into the REIT. So about 3.7 million square meters of commercial assets are still in Ayala Land, giving A-REIT at least 8 years of asset infusions and potential inorganic growth.
In April to May, a series of high-profile corporate arrests had rattled confidence in Vietnam's stock markets, wiping out about $40 billion. The property development industry too has had its fair share of crackdowns over the past few years for corruption, especially for land acquisitions. On top of that, there have been regulatory bottlenecks. The government has indicated it is committed to stepping up.
Mr. Ching, the new PM, he and his cabinet knows very well that this real estate sector is a key sector in Vietnam. It's about 20% of the total asset of the entire country and about 12% of the total income of the economy, right? So therefore, definitely, in order to come up with a completion of a regulatory framework is number one on their list of priorities. So definitely this period is going to go, and our expectation is that towards the end of 2022, we're going to see lights at the tunnels.
That was Maybank analyst Tyler Nguyen, who is based in Ho Chi Minh City. What supports the property sector is that Vietnam is in a double sweet spot for its young demographic and middle income per capita of $3,000.
Number one is a big and young population of about 100 million people. Most of them are actually under 35 years old. The second thing is that the middle income class is actually rising at a double digit year on year, while income per capita is actually quite low base, about $3,000 per annum. In terms of the middle income population growth, right, CAGR for the past 5 years about 30%, while peers in the region is about 10 to 15%. For Indonesia and Philippines, while Singapore, Thailand, and Malaysia is even lower, less than 5%. Urbanization, right, in Vietnam is very fast as well. Growth is also the fastest in the region with the lowest penetration. So you're looking at about 35% of the population are actually living in the urban area in Vietnam. While you're comparing that figure with ASEAN peers, everybody has 50 or 55% at the lowest and over.
Inevitably, as income grows, the demand for quality housing will go up too.
90% of the population is still living in a self-built, low-rise terrace houses. So if you've been to Hanoi, Ho Chi Minh, and you see all the terrace houses, around, so that is, the majority of the population are still living in that mode of accommodation. Infrastructure is still at a very nascent stage, and especially basic infra such as roads and bridges are being built new year on year, and it's been the government number one focus so far. So therefore, this sector, the real estate sector, will continue to thrive. They will benefit both in the midterm and the longer term through, though there may be some turbulence in the short run.
Of the various property segments in Vietnam, residential, industrial, retail, and so forth, where do you see the biggest growth?
Fastest growing and most sustainable is residential. Comes with industrial parks because FDI still continue to flow in Vietnam double-digit wise year on year. In terms of commercials, real estate, even though right now is still quite good for Vietnam, being growing in terms of the consumerism in Vietnam, right? You see a lot of Thai players as well as Japanese player like Aeon, Central Group. They're all coming into Vietnam. Lotte Group, they're coming into Vietnam, invest a lot. However, because of COVID, slowed down a bit in terms of physical retails form in Vietnam, even though it's very underpenetrated. And if you were to look at the numbers of penetration, the contribution to the total retails of the e-commerce, right, is only about 2 to 3%, and they're growing like double digit every year. It's still very small compared to traditional retails. Still, that is going to be slightly lower compared to our previous forecast. So I think if you were to rank 3 of those subsectors, right, then I would go for residential as the number 1, strong growth, resilient. Number 2 would be industrial park, that is related to FDI growth. And number 3 will still benefit a lot, but slightly lower compared to the other 2, which is the retail commercials properties.
What is the likelihood of an Evergrande China crisis in Vietnam, or perhaps a smaller crisis due to property developers overbuilding and over-leveraging?
What is the problem so far for the government to having to address the issuance of corporate bonds is still skyrocketed in the past 2 years? The worries actually are quite real. The corporates in Vietnam, including developers, are gearing up very fast. However, the size of the debt market in Vietnam is still relatively small. So we are talking about less than 7% of the GDP versus regional peers such as Thailand is about 20%, China and Singapore about 28 to 30%, and Malaysia is about 50%. So if we were to look at properties, right, usually there are many factors to dictate the liquidity ability of developers, including margins, sales, and execution. So if a developer can sell fast enough or has enough margin on a project, the down payment of those sold units could be a great cash inflows for their needs. So they need a lot of short-term cash, and the down payment, right, can be a cash inflow that helps them a lot. Therefore, the gearing itself may not be the only factor to dictate the financial health of a developer. In Vietnam, developers now, they enjoy a superior absorption rate and margin versus peers in the region, especially China. That is also because of the stage of the economy and the real estate market right now in Vietnam the gearing is only slightly higher compared to regional market. We're talking about 100%, 80%, 100% right now, but it's still within an acceptable level compared to China, right? China is it's very normal for developers to overgear to more than 100%. And if we were to look at gross margin for a general project in Vietnam, right, a developer can easily fetch 40 to 45%, while absorption rate that they enjoy is usually more than 90% depending on the project, but it's more than 90% on average. Those figures are substantially lower with regional peers. We are talking about ASEAN, and even lower than that in China, right? In China, gross margin for Chinese developers are reaching about 15 to 20%, while absorption rate is about 30 to 40%, right? Regional peers like Malaysia also having the same problems. The absorption rate is really low, 30 to 35%. So the income per capita is also different. Therefore, the risk of an Evergrande problem in Vietnam, I think, is going to remain a concern rather than a serious threat.
On this note, and given external headwinds, what are your top property stock picks?
I think I can do 3 picks, which is big cap, mid cap, and small cap. Big cap is actually Nova Land Group. Ticker is NVL. So this is a big cap that is very trendy and ambitious. They are having good land banks in areas that have to have a future roads connectivities. The story of turning around is visible when tourism is coming back and they can launch the hospitality real estate division more aggressively. Mid-cap pick is Nam Long Investment. Ticker is NLG. So this is one of the oldest developer in Vietnam, actually, and they recently having the ambition to join the $1 billion market cap club. The execution and brand name has been quite great, and they have the ambition to build their first ever satellite township. So imitating Nova Land or Sovin Homes, which is the leader in Vietnam right now, with the execution ability that they have, I believe this counter is soon to be able to transform itself to a $1 billion market cap company.
What about the small cap players?
Small cap pick is Van Phu Invest, VPI. So for Maybank, we also have a non-rated note for this company quite recently. VPI is a long-term developer in the northern part of Vietnam. They've actually been around for more than 20 years. Right now, they are focusing to be the pioneer in the second-tier cities in Vietnam, right? So the first-tier city, Hanoi, Ho Chi Minh, Da Nang, they are quite developed already and has a lot of offerings for consumer. But when it comes to second-tier city, modern housing form is still quite a new concept to them. So therefore, when a VPI comes into those kind of second-tier cities, then they actually can fetch a quite high selling price, but the land cost is actually quite low, so means that they can actually have a significant growth in margin. So that is also the reason why I think Văn Phú VPI is also one of the quite an interesting idea to take a look at as well.
Following up from your point on developing second-tier cities, can you give us some names?
Actually, Hanoi and Ho Chi Minh City are like the two hubs of the northern part and the southern part of the country. So the country is quite long, right? From north to south. The main government infrastructure project right now is to build a highway to connect Hanoi and Ho Chi Minh City, right? We already have a federal way, a federal, not to say highway, but a federal way of connection. But then you need like a highway with high speed. And most of the cities that are considered second-tier cities are the one that having the north-south highway going through them. In the northern part of Vietnam, there's Bắc Ninh and Bắc Giang. So they are just like 30 to 70 km away to 100 km away from Hanoi to the northern part of Vietnam, to the northern part of Hanoi. And in the southern part, you're talking about Vũng Tàu, you're talking about Phan Thiết, southwest coastal part of Vietnam, which is toward the northern part of Ho Chi Minh City as well. So those are the two areas that can be considered as a second-tier city in Vietnam.
And that wraps up our coverage of real estate in Singapore, Vietnam and the Philippines. Follow us on Spotify and Apple Podcasts for market and economic updates. I'm Noelle Lim on ASEAN Speaks by Maybank.